Hello and welcome to BQ Prime. Today we're on a special episode exploring what's possibly stopping credit rating agencies from upgrading India. Currently, Moody's rates India at Baa3 negative, while Fitch and S&P ratings have rated triple B minus. Now, in all three cases, these are the lowest investment grade ratings. We're joined by Madan Sabnavis, Chief Economist at Bank of Baroda. Sir, hello. Thank you so much for taking time out. So you recently written a column, expressing your disagreements and your rationale for why India deserves a credit rating upgrade. So we'd like to know a little bit more of your perspective on that.
Okay, see, it's like this, Pallavi, that when we are talking of a credit rating of a sovereign, the basic question we are asking is that if there is money being lent to this particular country, is the country in a position to service the debt? This holds for corporates when you're doing a rating. This also holds for countries. Now, countries are actually quite different from corporates in the sense that as far as any country is concerned, which includes India, we always have the right to print notes in order to service debt in the worst case scenario. Okay, and this becomes important because if you're looking at a country like India, we don't really have any government debt which is based in dollars. The entire raising of debt is being done within the country itself, which means there are rupee loans being given. So even in the worst case theoretical possibility, if there is a problem in terms of servicing debt, you can always print currency. So that's one of the reasons as to why I feel that whenever you are doing any kind of rating exercise of sovereigns, one needs to be a bit more guarded. One needs to look at the overall picture rather than just concentrate on one particular aspect, which the rating agencies seem to be doing, which is saying that the debt levels of the government tend to be on the higher side. Now, if you look at the kind of progress which India has made over the last few years, it's been quite amazing. Even if I go back to the pre-pandemic times and bring you right down till 22-23, I think it is accepted that India is definitely one of the best performing economies in terms of economic growth. In terms of inflation, I think inflation has generally been kept at a very low level in the last 5-6 years. Even when we're talking of a 6% inflation number, I think it's a very reasonable one for a developing economy, given the fact that there is a lot of inflation which is caused on the food side. So inflation, to my mind, is something which has definitely been controlled. We are no longer talking of inflation in the region of, say, 9, 10, 11%, which was the case maybe around 10, 15 years back. So the fundamentals of the economy are strong. Now, next, what we need to look at are the external sector indicators. And here we have seen that the Indian economy, in terms of the balance of payments, has been strengthening over time. So when I say strengthening over time, the best indicator is that what is happening to our forex reserves at the end of the day. Because whatever happens in terms of the external account, in terms of inflows and outflows, the net result is in terms of accretion of foreign exchange reserves. These reserves have been increasing, and today we're talking of something they have actually crossed the 600 billion mark. So let's say we're talking of something like around $600 billion today. Are they adequate in order to cover our imports? Yes, today it's in the state of around 8 to 9 months. And this has been the case, I think, for the last couple of years, where the forex reserves provided a lot of cover for the imports. So this being the case, I think there was always a strong case for saying that the Indian economy is definitely much different from what it was when historically a rating of triple B minus was accorded. And there was a reason for one to upgrade India. And I think the final test, Pallavi, when we're talking of the what we call the investment worthiness of a particular country, is what do foreign investors feel about India? So it's one thing to say that the rating agencies feel that there's some bit of fragility in terms of, say, the poverty levels being high, inequality being there, in terms of, say, the government debt ratios being high. But if you look at the foreign investors, foreign direct investment, FPI, now these are the two people who are actually putting the money on the table. If they have been coming and investing a lot in India, I think India has been getting around $80 billion. We had an aberration this year, but otherwise we've crossed the $80 billion mark for 2 years. We're looking at FPIs, where India is one of the favored destinations for portfolio investors. So these people really think that India is a very good destination, and they've not had any problems in terms of capital repatriation, because we have full capital account convertibility for foreign investors. So this being the case, I think there is a very strong case for saying that India deserves a better rating. And what the rating agencies, they seem to be still in that old time saying that there are certain indicators like the debt indicators that since it's high, we cannot give an upgrade. But we should remember debt is actually a stock concept. When we say it's a stock concept, it's something which will keep increasing. What you need to see is to say that is the government doing something in order to control the fiscal deficit? And here I think we have done very well in terms of bringing down the fiscal deficit level. In fact, even during the pandemic, contrary to what lots of developed countries and even emerging markets did in terms of giving cash to citizens, cutting off taxes, I think the government of India didn't do anything. They sort of helped the people who were required in terms of free food being provided, some of the food subsidy component going up, but otherwise there were no freebies as such which was given to all and sundry. So it was a more guarded approach which was taken, and that is why I think it's been easier for the Indian economy to recover from whatever happened during the lockdown times. So I think keeping these conditions in mind, I think it's a strong case for saying that based on the current situation, and when I'm talking of current situation, it's just not fiscal 23. I'm talking of, say, the last 5 years experience. The Indian economy has progressed quite dramatically from what the picture was earlier, and just sticking to a rating of BBB minus is not really very convincing.
Sure. Okay. So like you mentioned, that a couple of things that rating agencies, all the major ones, continue to emphasize on is India's weak public finances, illustrated by high deficits and debt relative to peer countries. So, let's start with the FRBM Act, for instance. Now, even going back to before the pandemic, the FRBM had sort of become a moving target. And we have failed in most years to actually adhere to the fiscal consolidation path that has been set out. And going forward as well, looking at what the government's target is for FY26, rating agencies remain skeptical of whether the government will be able to meet that target. Likewise, they have emphasized even on the pace of fiscal consolidation and how India will have to squeeze its expenditure here on if it does plan to reach its target. So, I mean, any further thoughts on that?
Yeah, I think this is an interesting question because when we are talking of, as you mentioned, the FRBM targets have been kind of rolling targets. We seem to be changing them. So I think this is the kind of a straitjacketed approach which rating agencies seem to be taking whenever they look at emerging markets and developed countries. Now, let's go back to the fundamentals saying that what is so sacrosanct about having a fiscal deficit ratio of 3%? Where did this 3% number come from? Now, this particular norm is something which was self-imposed by India to bring about fiscal discipline. And in fact, if you look at the way in which state finances have been handled, they have been largely accomplished. There's a lot of discipline there because you can just not go beyond the 3%, 3.5% or 4% mark, whatever has been put there. It's only for the central government that there is a lot of flexibility which has been afforded. But there's a reason for this, because if you look at a country like India, where admittedly there's a large amount of people who are in the low income groups, there is a lot of support which has to be provided by governments in emerging markets. And therefore, to use the same kind of a criteria as what is being used for developed economies, to my mind, is not a fair thing. Now, why do you say this? Like the 3% mark is something which, say, the Eurozone is something which has been persevering with. Now, this 3% mark is something which you're talking of developed countries where you have a high level of incomes across the countries, where you don't require that kind of intervention coming from the government in order to make sure that subsistence living is something which is possible. Whereas the moment you come to the developing economies, at the emerging markets, I think the priorities are quite different. So when I say that we have done very well in terms of the fiscal deficit, yes, I agree. The numbers have not really adhered to the 3% mark for a very long period of time. But the fact remains that it has to be an evolving kind of a number. We have to make sure that in the quest to retain this 3% number, we do not make sure that the entire country starts suffering because we are meeting the requirements of rating agencies. So I think that's the basic point which has to be made, that we need to have a different approach when you're looking at emerging markets and when you're looking at developed markets. So if we're going to use the same criteria, yes, then we will be running into this issue. And there will be no answer, because today if you're asking me whether we'll reach this number of 4.5%, one hopes we will, but one can never be sure, because in case there is another shock which comes through, it's just possible that the government may again have to intervene, in which case we may be off the mark again. But what is more important is that when I'm looking at my fiscal numbers, have we brought in the kind of reforms which are required? Now, GST, I think, has been a very big reform which the rating agencies have been harping on prior to 2016, saying we don't have a goods and services tax. Now, once they bring it in, we have seen it's worked very well. It's more compliances, more people are being covered, and I think it's worked out very fine. So I think that is a major achievement for which I think we need to be given credit. So I think, and even in terms of spending, if you look at the quality of spending of India, I think that is something we need to focus on, that how much is being spent on, let's say, on capital expenditure, that is the non-committed expenditure. So I think one needs to acknowledge the improvements which have taken place on the fiscal side, and accordingly you need to consider upgrading it. But if we are doing very well on all other parameters, I admit that on the fiscal side, numerically we have not been meeting it, but you'll have to see what is the qualitative changes which have taken place, and has to be an acknowledgement. Now today, if you look at the commentary made by most of the rating agencies, it seems to be no different from what it was 5 or 6 years back. You acknowledge that there is a GDP growth. In fact, that time we had 8% plus growth. Today we are saying we're the second fastest growing economy in the world, the fastest growing economy in the world, rather. So with these kind of conditions, which are all which talk positively of the economy, we still decide that we're not going to change the rating because of the fiscal side, and we're actually ignoring a large part of the improvements which have taken place on the fiscal front.
Okay, so you believe that rating agencies have been following a very cookie-cutter approach over these years, and ratings need to be a little more dynamic to reflect changing conditions.
See, absolutely, and this holds not just for India. If you look at most of the emerging markets, it's the same kind of standard which is set. It becomes very, very difficult for an emerging country to actually get an upgrade. In fact, in a very unbiased manner, I would say that I'm not saying that India should be a AAA or a AA rated country, but I feel that a rating in the A bracket is something which can definitely be defended. So it is something which
that sounds ambitious.
Sorry, no. The thing is, we just don't know. I'm saying this based on if you compare our economic parameters, say for the last 3-4 years, with similar rated, comparable rated countries in the grade of A, you'll realize that India seems to be.
Correct me if I'm wrong. I don't actually remember seeing too many non-developed economies in the AAA bracket. There are some developing economies which do have better credit ratings than India, Malaysia, for instance, but there again, arguing from the point of view of a rating agency, it does have slightly lower public debt than India does.
So that's true. That's absolutely true. You don't see too many emerging markets, and even the ones which come will be a much smaller size countries compared to India.
Yeah.
But if you actually look at the external sector, look at the external parameters, I think what we see in India is definitely very impressive. And as I told you, the final vindication is saying that. The final vindication is that if we are seeing foreign investors who are investing in large quantities, they're not really looking at the ratings. And the problem which India has is that Indian government actually doesn't get affected because we don't borrow in international markets. But unfortunately, what happens is when Indian companies have to borrow in international markets, the country ceiling becomes a kind of a barrier. You can't go be better than the sovereign. So I think that's where the issue is. And that's why I think we need to argue and keep talking to the rating agencies and convince them that we need to change their overall approach.
All right. So again, pretty much across rating agencies, they collectively seem to be of the opinion that implementation of a credible medium-term fiscal strategy to bring government debt and the interest revenue ratio down would help move towards a rating upgrade. Similarly, higher and sustained medium-term investment and growth rates. So, I mean, keeping in mind these factors, over the next few years, do you see India getting a rating upgrade?
See, I'm not actually quite sure because, in fact, very often the outlook may probably change to positive. At times they make it negative, but I've never really seen that. It's a kind of what we say. It's a kind of, if we go back to a little bit into religion, into mythology, you'll say this Agni Pariksha seems to be happening every time. So whatever the country does, it never seems to be good enough to justify a rating upgrade. We always seem to be on the periphery of BBB minus. Maybe at times the outlook will be positive, at times it will go into negative. But I've never seen the Indian economy actually being upgraded. So I think when we keep talking a lot about the good things which have been happening, and I think lots of them are credible things which have happened, I think it doesn't seem to be acknowledged when it goes into the ratings. So that's why I feel that they need to probably revisit the entire methodology and the approach towards rating. But just look at the situation. We have an American debt ceiling which comes up every now and then. And if we know very well that the US economy will never, the US government will never default. But the fact that you have this issue coming up periodically creates a lot of chaos in the markets.
Absolutely.
And yet that's something which does not seem to be moving the rating agencies. So there's definitely something. I agree. America can also print dollars as many notes as they want to. They'll never be. But why should this issue ever come up? And it doesn't seem to be raising the antenna for the rating agencies.
Sure. So again, considering the emphasis on public finances, this year we saw the government pretty much in line to meet its fiscal deficit target. And now with a higher than estimated GDP growth, what's your expectation? What's the fiscal deficit for FY23 looking like? And do you believe we're on track for FY24?
See, I think that they had targeted 5.9%. In my mind, that's something which would be achieved. But admittedly, it's still a long way before we can reach the 3% mark. And I think 3% will probably be a very, very ambitious number. And we'll have to first see about the 4.5%. And the reason being that today we are seeing that since there is not too much of private investment taking place, I think that's one of the reasons why the government is doing this heavy lifting on the part of the investment. And that's being done by both the center as well as states. States are constrained because they have to work within this fiscal deficit ratio of 3.5% or 4% based on whatever is permitted, based on the criteria, the achievements on those three criteria. But I don't think that's adequate. So there will be slow movement in terms of overall investment rate, because that's going to take some time before we cross the 30% mark. But until such time, I think the government will continue doing it, and I think that's what should be done. We cannot let the economy and the investment rate slide because the private sector is not investing. So I think we should be tolerating a fiscal deficit ratio of closer towards 4%, and that's what should be the target, or rather the final target once we reach the 4.5% mark.
All right. Thank you so much for taking time out to share your views.